Good evening, ladies and gentlemen. This is Barry Norman on behalf of investing.com and Trade Time, and welcome to our webinar. And I want to wish you all who enjoyed the festive holiday season a great season. For those of you that are preparing for the new year, have a happy and healthy new year. And for those of you that enjoy or celebrate anything else, it's still a great season, a great time of the year, and welcome to our class. Tonight's class is sponsored by Trade Time, one of the world's leading providers of Forex and CFD trading. And they have a very unique offering to traders. Everything with Trade Time is customized to fit your personalized trading approach. You define your objectives, you customize your account and your dashboard. You tell them exactly what level, what personality you have, and everything they do with you will be aimed at it. If you're a shark, if you're a beginner, if you want just an easy trading, you want high profit trade, whatever it wants, you will customize your account, and they'll make sure you get all the data that fits you. Only the emails, the updates, the alerts on your channel will be designed for what type of person you are and how you want to trade. Now, Trade Time is also a regulated provider, but they offer you a great set of unique tools. And you see, when you go to their platform, you can trade right on their platform, and you can trade indices, Forex, cryptocurrencies, and they give you market trend updates right on the platform, so you can see how every asset's doing, how traders are trading them. You get up to the minute news and everything you need right on the Trade Time live platform. You also get some of the most advanced trading signals in the marketplace. Not only do they give you a position, an asset, they tell you what direction, but they also tell you each objective. So you can monitor them along the way. It even tells you where to put your stop loss. And it tells you how many traders have taken advantage of this signal and are trading that asset based on that signal. So you can see how well that signal is doing and decide whether you want to join it, the first objective or the second. So give Trade Time a shot. And while we're getting class tonight, if you go to www.tradetime.com, you don't need a credit card or any personal details, and you can see and start customizing your own trading platform and open a demo account and just feel your way around and see how unique it is. It is the next generation of trading. Now, tonight's class is being recorded. And if you want to see a recorded version of this after the class is over, just go to investing.com. You know where you're enrolled in the webinar at www.investing.com. Locate the Education tab, and then look for Webinars on Demand. And you'll see not only this class, but you'll see every class that's ever been offered, and you can watch them at your convenience. Now, tonight we're going to talk about the fundamentals of Forex. Okay, and it's really about fundamental analysis, or what type of analysis and how these events or this fundamental analysis affects the Forex market. Now, fundamental analysis is a method of evaluating a security or an asset in an attempt to measure its value by examining related economic, financial, or other qualitative and quantitative factors. Fundamental analysis studies anything that can affect a security's value, including macroeconomic factors such as overall economy and industry conditions, and microeconomic factors such as financial conditions and company management. Now, the end goal of fundamental analysis is to produce a quantitative value that an investor can compare with the security's current price, thus indicating whether the security is undervalued or overvalued. So as you start trading and you come to Forex, and tonight we're talking primarily Forex, it does affect assets like gold and platinum, has some effect on cryptocurrencies, has very little effect, but some rollover effect on stocks is what we're going to be talking about tonight, because we're talking primarily tonight about Forex. Now, fundamental analysis studies everything from the overall economy and industry conditions to financial conditions, whereas technical analysis is the evaluation of securities by means of studying statistics generated by market activity, such as past price and volume. So basically, technical analysis is everything that's done with price action on charts, where technical analysis deals with the real world. It deals with economic events, speeches, headlines, central bank action. Now, fundamental analysis uses real public data in the evaluation of a security's value. So if you're looking at a stock, you'd be looking at quarterly earnings. Statements like Apple came out today, or I guess on Friday, with a warning that they're expecting a lot lower sales on Apple. So Apple stock tanked today. Because remember, today is a European holiday or a UK holiday, but it's not an American holiday. So the markets are open in the US today. Now, an investor can perform fundamental analysis on a bond's value by looking at economic factors such as interest rates and overall state of the economy. He can also look at information about a bond issuer, such as potential changes in credit ratings. For stocks and equity instruments, this method uses revenues, earnings, future growth, return on equity, profit margins, and other data to determine a company's underlying value. In the terms of stocks, fundamental analysis focuses on financial statements of the company being valued. Fundamental analysis is built on the idea that the market may price a security wrong from time to time. Profits can be made by finding underpriced assets and waiting for the market to adjust the valuation of a company or an asset, a currency. By analyzing the financial reports from a company or from an economies, you can get an understanding of the value of different assets and understanding the pricing in the market. After analyzing these factors, you have a better understanding of whether the price of a security is undervalued and overvalued. Fundamental analysis can also be performed on a sector's basis and in the economy as a whole. Now, each type of fundamental analysis has to be relevant for the markets. But again, because the particular market. Now, even though we're talking about the fundamentals of Forex tonight, these fundamental factors like a central bank action or a speech by Mario Draghi can send the euro or the US dollar up or down. But a thing like housing data out of the US, which is a very important report, and if housing data sinks, that's going to have an effect on the dollar. But guess what? It also has a flow or an overflow effect on the value of, say, stocks like Home Depot and major builders. Because if housing's down, they're going to be selling less of their products. So you have to see what data affects what markets and how it has an effect. The market reaction to any type of data, though, is unpredictable. This is not only the case when news is released in line with analysis expectations as published by news channels and financial news providers, but also when the release surprises significantly. Sometimes it's not even possible to predict how volatile the market's reaction will be. Sometimes the markets will move within a 50 or more point in relationship to that. Sometimes a 100-pip movement is the span of 1 or 2 minutes and will be reversed and completely and negated by the end of the day. Conversely, while news releases are usually the most volatile period for typical trading day, a very unusual release may be welcome with relative calm. And it's very hard in many cases to understand why the markets act and react that way. But if you understand all the types of data and where it's coming from and how it has flow over effects, you can then start to predict how the market should react. Okay. Just because Janet Yellen becomes more hawkish and more positive doesn't actually mean the dollar's going to go up. Look, when we had the last rate increase, so 2 weeks ago, the dollar didn't go up at all. And normally, under textbook examples and all historically, whenever there's an interest rate increase, the dollar surges. Didn't do a damn thing. In fact, over the next few days afterwards, it fell. Now, these have a major effect on commodity prices as well as Forex prices, as well as global indices and stock prices. Now, every country around the world releases its own economics data, but each country releases virtually the same data. Sometimes they're called slightly different, but they all release the same data, not necessarily at the same times. And each report doesn't have the same significance. Like in the UK, construction PMI and services PMI is much more important than manufacturing PMI, because it's big. Number one, the financial industry overall for Europe, it's the financial hub for Europe, and as well as the UK is very much based on construction, and this is a very important number to them. So you have to understand all of these major fundamental reports and how they affect other things. Because unfortunately, too many traders, number one, see the euro going up or down, but can't tell you intrinsically whether it's overvalued or undervalued, can't tell you what its average range has been over the last 3 years, and can't really tell you what the value of it is. They just see, oh, look at that, the euro went up, so I can trade it to go down. But they don't understand where it's coming from. And if you actually understand all the data and why and how it has effects and what it flows together, you'll become a better trader. Now, there are several categories that are ultimately important to fundamental analysis. And one of these, or the most important, the one we talk about a great deal, is inflation rates. Now, everybody says, okay, why is inflation rate so important? Or why do we want to maintain inflation at 2%? And why? It sounds like if inflation is down or negative, it would be really good. It means I'm spending less out of my money. The goods in the stores cost less. Well, remember, the whole economy is a cycle. It's like a mouse running in a little cage in one of those little round circles. Everything has to keep going. And each spoke of the wheel has to be fulfilled, because inflation isn't only about how much you're going to pay for goods. Now, the best way I can explain this, and unfortunately, not unfortunately, a lot of people don't have a good grasp on this. But if I were to tell you that if you take if you have 500 euros, you can go to the grocery store and buy all the food your family needs for the next month. 500 euros is a lot of money, but if you're feeding a family of 4 for a whole month, okay, that's okay. Now, if inflation goes up, means you go to the store and you want to buy those same groceries, but now it's 520 euros. Well, yes, that hurts you. You're mad. You got less money to spend. But if in Australia, they had been able to buy that same monthly groceries for 500 Australian dollars, and now they're going to the store and they can buy that same groceries for 480 Australian dollars, because they have lower inflation and the UK's got very high, or the Euro's got very high inflation. Where would people want to be moving money? And we're not talking about you as an individual. Where would big companies want to be buying their goods? They want to be buying their goods or their services where the inflation's lower, because they're going to get more value for their money. So the money flow switches. So changes in market inflation cause changes in currency exchange rates. A country with a lower inflation rate than another will see an appreciation in the value of its currency. The price of goods and services increase at a slower rate where inflation is low. A country with a consistently lower inflation rate exhibits a rise in currency value, while a country with a higher inflation rate typically sees depreciation in its currency and is usually accompanied by higher interest rates. Changes in interest rates affect currency value and the dollar exchange rate. Forex rates, interest rates, and inflation rates are all correlated. Increases in interest rates cause a country's currency to appreciate because higher interest rates provide higher rates to lenders, therefore attracting foreign capital. So when a central bank raises the rates and you're sitting with lots of cash, you'll move your money where you can get a higher rate. If you have to borrow money, and we're talking about not, again, you and I, we're talking about when a deal has to go through from one company to buy another company for $1 billion, and they're borrowing that $1 billion, even if they're only borrowing it for a month or two while they do whatever they have to, they're going to move that deal to whatever country and bank is safest, but it has a lower interest rate. because that when you're borrowing millions of dollars, that low interest rate is important. But look, we talked. I don't even know what the number is anymore. But Apple was sitting with so many billions of dollars in cash overseas, outside the U.S., but billions and billions and billions in unused cash. Well, they make money on that money. It's short-term or long-term rates at their banks. Now, if Spain is paying a higher interest rate than Portugal, where do you think they're going to move their money? So first, with the ECB, they all virtually pay the same. But if the Bank of England had raised its interest rates from paying a higher interest rate than somewhere in the Eurozone, they would just move their cash into that bank that was paying the higher, because they would be making more money. When you got $1 billion on deposit, that eighth of a point is a lot of money. So therefore, higher rates bring in more foreign capital. Now, we also have what's called a country's current account. And this current account reflects the balance of trade and earnings on foreign investments. It consists of the total number of transactions, including its exports, imports, debt. A deficit in current account due to spending more of its currency on importing goods than it is earning through the sale of exports causes depreciation. Balance of payments fluctuates exchange rates for its domestic currency. And when this is in a negative, it also detracts from foreign investors. Then we have government debt. And government debt is public debt or a national debt owed by the central government. A country with government debt is less likely to acquire foreign capital, leading to inflation. Foreign investors will sell their bonds in the open market if the market predicts government debt within a certain country. As a result, a decrease in the value of its exchange rate will follow. So as you see, each one of these are just key puzzle parts in determining the value of a currency. Now, granted, most of us are CFD traders and Forex traders that are trading short-term markets. But a smarter player is somebody who's playing the markets not over a year, a week, but they're trading it over a couple-day period. They're trading it because when you're trading the ups and downs on a day trader, you're a lot of stress. Okay, it's a lot of risk. But if you're saying the euro is currently undervalued based on my analysis, and it should slowly go up and reach a new level because everything, all the economic reports are good, whether it takes a week or 2 weeks or 3 weeks, you don't care. You're going to make money. Okay, and so it just depends on what type of investor you are, and also what the market reaction will be immediately or in the short term to these reports as they are released. Because fundamentals are one of the most important factors affecting the price movements on daily price movements of the currency market. Now, terms of trade. Related to current accounts and balance of payments, the terms of trade is the ratio of export prices to import prices. A country's term of trade improves if the export prices rise at a greater rate than its import prices. This results in higher revenue, which causes a higher demand for the country's currency and an increase in its currency value. Why? If the U.S. is exporting more goods than it's importing and it's increasing higher, and the U.S. companies are charging in dollars, which you usually charge in the currency of your home country, that means all those companies out there that have to pay their bills have to pay you in dollars. So they're buying up dollars. It causes an appreciation. Now, during a news release, a number of speculators will react, hoping to gain quick profits and exit. This will create a very brief ballooning of spreads and volume in the immediate term, but also will distort the underlying technical picture greatly. As these initial buyers and sellers exit, momentum traders will attempt to join in and fuel a more sustainable short-term trend with their action. Depending on time and liquidity in the market, they may well be successful. But sometimes they too are checked by previous unknown order layers that check the advance of the price. When these absorb the momentum traders and the short-term speculative entrants, the initial reaction of the price may be reversed or negated. So you can be one of those short-term traders inside that whole bounce, Or you can be the guy sitting on the outside waiting for that to clear out, and then you can get in a trade to let that asset move up slowly and surely, or down. Now, there are three ways of trading these news events. First, you need to understand how they all correlate together. Okay, which are important, what assets they'll affect, and you have to learn. And if you come to our class on trading the economics, we'll teach you how to build a matrix and market neutral, market positive, market negative, because you have to learn to read the economics calendar. You have to learn how to understand what the shadow numbers are and what the forecasts are, and how to break them down to decide what the initial market reaction will be. But then there are different ways you can trade the news. Now, part of trading the news can be being a smart trader. And this is how you would use what's called order entry. Okay. If you're not sure how the market's going to act or react to a asset, you can use an OCO. One cancels the other. And you can actually set up ahead of the event a trade in either direction and set them, say, at the next support and resistance level. And when one is executed, the other one's automatically canceled. So if you think the trade that is going to come out and it's going to send the euro up, if it's positive, it's send the euro down if it's negative, you can take a position on either side using an OCO order. And if the market number comes out positive and goes up above the level you set, it's going to automatically execute a buy order. If it falls down, it goes down below the number you set, it's automatically going to execute a short order, and it will cancel the other order out. So this is one way that you can trade these fundamentals, very easy way. Some traders position themselves on both sides of the market before significantly using a hedge position. They wait for the number to come out and then proceed to trade out the position. For example, they might take a loss on one side during a post-number correction after having hopefully taken a larger profit on the winning side of the trade. This straddle or hedge strategy consists of going both long and short in the same currency pair before the release of the economic number. Action is not taken until after the number is released. Once the number comes out, the trader must decide how to leg out of the two-legged position. Now, this is actually won by generating two trades. You buy and you sell. Now, generally, this involves taking both a profit on one and a loss on another. So you have to have one go high enough in your favor or far enough in your favor, while the other one you make sure you stop out of your close as soon as you're sure the market's not going that direction, and you get out of it. So you take a small loss on another while you make a big profit on the other side. But you have to understand these events and how they're going to affect the economy. If the number was favorable, often the traders will first take profits on the trade first. This enables the trader to allow the other unprofitable leg of the position to decrease the losses on the position as the market corrects, after it made an initially often exaggerated reaction on that number. If the number release was unfavorable, the same basic follow-up strategy can be taken as the market falls by closing the winning short position first and then trading out of the losing position side of the hedged position. A variation of this technique involves placing a stop loss immediately on the losing position and waiting for the stop loss to be hit. Once the stop loss has been filled, the winning side of the position can be held for an additional profit or liquidated immediately. So it's complex, but it's not very difficult, and it's straddling just both sides of the market. Now, first you have to understand where support and resistance are, because you would want to put your entry point right above the support level. So if the market breaks up, it will end that you can buy right above that support level, and if it falls down, you'll buy right below the resistance level. And that's how you figure your entry and your exit points. Okay. And so this was a range of 44 pips in this event, and you would put your stop losses at 20 pips in either direction. So when the market surges up, this one would have been stopped out at 20 points, the down would have been stopped out at 20 points, and you would have taken the profit on the upswing. And this is called a straddle. And it's not a very complicated strategy. In other words, you're not using lots of technical indicators. You're using this in combination with fundamental analysis. What the event is, when it's being released, and you can tell that from the economics counter. But several academic studies have established that the impact of some news announcements have their immediate impact spread over a period of weeks or months, instead of a single day in which the markets are thought to discount them. The non-farm payroll report, and to a greater extent, the interest rate decision of the Federal Reserve are good examples of this kind of news flow. While the markets react violently and unpredictably in the short term, the mechanisms set up by low interest rates or full employment have consequences that are relevant to many sectors of the economy, and trading them on a long-term basis is certainly possible. The trader who uses this strategy will build up his position slowly and will attach greater value to low-frequency releases such as GDP reports, and wait until the overall picture offers clarity before he makes his trade decisions. On the other hand, short-term traders, to trade the news on a short-term basis, the trader must have a clear criterion for what kind of news will justify a trade. Many news traders seek at least a 50% surprise in the data to consider a release tradable. A novice trader, in turn, can use the initial period of his trading career for perfecting his money management skills. Trading the news on a short-term basis can be easy and lucrative if a trader is disciplined enough to cut his losses and accumulate profits. But panic and mood swings and undisciplined methodology will quickly erase all the gains through shock and volatility. There are various types of indicators which have the potential to cause the greatest short-term movements in the markets. To trade the news on a short-term basis, a trader must have a clear criterion. Now, I explain all this by using a sample of your kids and their report card, because we'll go into greater detail in in a class on trading the economics counter. But if you imagine any of these reports, whether it's inflation, interest rates, GDP, terms of trade, imports and exports, current account, okay, are all report cards or grades of the economy, the current economic situation. And even though we know these events way ahead of time, we know when they're scheduled, and whether it's the jobs report out of Australia, whether it's called the claimant count out of the UK or the non-farm payroll report out of the US, every country releases its unemployment, its jobs, new jobs created standard. Every country releases its inflation data. Okay, every country releases its manufacturing data. And they are, again, grading the current state of the economy. Now, if you're going to use it for long term, you're more concerned with grading what grade that economy is getting. Where if you're trading in short term, you're more concerned with the difference between what is expected and what is actually happens. So if you think about this as in terms of a report card, imagine your kids came home and you're sitting down for Sunday night dinner. Now, you're talking to your son. He's a really good kid. You have no problems with him. He's in high school. And you know report cards are due on Wednesday. And you say to him, well, kiddo, how do you think you did this semester? He says, well, Mom and Dad, you remember last report card, I brought you home all C's. They say, yep, we remember. That's just like the last time the last time the GDP report came out, or the last time the inflation report came out. They said, well, how do you think you're going to do this report card? Now, report cards are due on Wednesday, but your son's pretty reliable. So, you're going to base, and he tells you the truth. He doesn't BS you. So you're going to base your forecast, your expectation on what he's going to tell you at Sunday night dinner. So he says, well, Mom and Dad, we had a lot going on this semester. Plus, I play on the football team and we had a championship game. He says, I think I probably did about the same. So now you're parents, you're good parents. You give them this lecture about going on to university, getting, scholarships and whatever else. You got to do better. A little bit time, less time on Facebook, and a little bit more time on the books. But you didn't go do any analysis. You didn't go into delving deep. You didn't go back to the school and talk to the principal about how the other students are doing, or find out they have a new rating system they're using for grades this year. Didn't find any of this out. You just know C's on the whole are average. And that's the problem, because you don't know exactly what this C stands for. You just know overall it's average. And unfortunately, with the economic events, you have to dig a little bit deeper. You can't just go on the assumption of this is what the markets are expecting. Now, because he told you it's probably going to give you a C this month, or this report card, you set your expectations at that C. Okay, no problem. Wednesday, he comes home, hands you the envelope with his report card, goes right out the back door. You open up the report card, and he's got all B's. You're thrilled to death. You're ecstatic. You have a very positive reaction. Now, this is what happens in the market. You have a very positive short-term reaction because you got better than what was expected on this report. But will it have an overall effect on the overall value? How will it affect the currency? So you open up the back door and say, hey, kiddo, you did really good. You know what? We're going to go over to McDonald's for dinner, and then we're going to go over to the sporting goods store. You can buy whatever you want because you're thrilled to death. Why? Because it was better than what you expected. Because on Sunday, if he would have told you he was expecting a B, you'd be happy. But today you wouldn't have this positive reaction because it would just been what he told you already, what you were expecting. And this is what happens with the markets. Now, a few minutes later, that soccer ball comes through the back kitchen window, shatters it all over the living room. Now you're pissed. You holler out the back door, go get the broom, go get this mess cleaned up. I told you not to play on that side of the house. I've told you that over and over again. So guess what? We're not going to McDonald's. You're not going to the sporting goods store. And again, this is what happens in the market. Anything can change and negate that report. Now, because if you're trading long-term, if you're trading short-term, this can have a very wispy effect on it. If you're trading long-term, that B still has a very positive effect. Even though now the soccer balls come through the window, the market's gone through, is all violent stuff. But as it gets past, as the window gets fixed tomorrow, and you're with your friends, and then the weekend comes, and now you're really happy, all that stress, you're not elated, you're happy, and you're bragging to everybody over Sunday dinner that your kid got straight B's. Okay, this is what happens with the currency also. A longer term effect is also available because it will clear out all that craziness and then find its new value, either higher or lower. And you can do this, but you have to understand, because what happens is, at some given point, this was really crucially important. But you haven't gone, again, back to the school and found out, well, you know what? The bell curve increased and everybody in this class got B's. So B's are like C's. Or maybe the school was up for some kind of grant and it needed a higher grade point average. So the principal told all the teachers to grade them a little bit easier. They don't know. But if you did some analysis and did some checking and some research, you might find out whether that was a good B or a fluke B, which has a great effect on the market action and reaction and the longer term value. So you have to consider and determine how to build market neutral, market negative, and market positive values for each economics event and the overall economic situation to determine what the value of that security will be. Now, again, we teach this in great detail when we teach you how to read the economics calendar, how to read it, look at the forecast, understand it, and everything else, because you have to learn in detail how to do this. But the most common way to trade news is look for periods of consolidation ahead of the big number. And just trade the breakout on the back of the number. This can be done on both short-term intraday basis or daily basis. So let's look at some figures and see how to do this. So this is not a hypothetical, this is a prior case. After a weak number September on the non-farm payroll report, the market was holding its breath ahead of an October number. And this, I'm just trying to give you the background here, which was to be released to the public in November. In the 17 hours before the release, the euro-US dollar was confined to a very tight trading range of 30 pip trading. For news traders, this would have provided a great opportunity to put out a breakout trade, especially since the likelihood of a sharp move at this point was extremely high. So the most common way is to look for these periods of consolidation. So as you can see here, we see the market way before the event is due consolidating. When it does, we have a pretty tight range. So you could have done a couple different things. You could have bought and sold above and below, put in orders to buy and sell above or below this level. Okay. Or you could have waited for the market reaction and entered the market at that point. Or you could have used an OCO and told it if the market fell below this point to sell, and if it bumped above that point to buy. As you can see, we had this little bit of violent reaction as the data was coming out. And as it all came out, the markets began to fall and fell all the way down and then found its new level. So there were many different ways that you could trade this, but it's a knee-jerk reaction. You have to be very fast, and it might not last for long, and you can get whipsawed out of it. You have to understand how to set your stop losses and how to trade, because this chart illustrates the indecision of the market leading up to the October non-farm payroll report, which were released in early November. Notice the increase in volatility that occurred once the worse than expected news was released. Okay. The markets had expected 120 jobs to be added in the U.S., but instead only 56 were added. This sharp disappointment led to approximately 60-point sell-off of the dollar against the euro in the first 25 minutes after the release. However, the dollar's upside momentum was so strong that the gains were quickly reversed, and 1 hour later, the euro-US dollar had broken its previous low range and actually hit a high, one and a half year high against the dollar. Because you have to understand that a very bad report at that time could have then had an effect on the interest rate decision was coming up right after that, and that would have possibly put off that interest rate decision. So therefore, they can have negating effects. You also have to understand that we might have been more interested in the unemployment number or the hours work number than the actual job numbers. But opportunities were plentiful for breakout traders, but bullish momentum in the dollar was so strong that such a bad payroll report failed to put a sustainable dent in the currency's rally. One thing you should keep in mind is that on the back of a good number, a strong move should also see a strong extension. Trading news can be very profitable if you can correctly guess which way price is going to move. Price can often move 30 or 40 pips very quickly on a big news release, but knowing which way it's going to move is very much a gamble. So most traders do not trade the news as it's just too risky, and often get stopped out as prices move one way than the other. Most traders have experienced this whipsaw effect when prices go up and then go down very quickly and sit and then down and then up. So it seems no matter which way you trade, you can always get stopped out. So there are many different strategies that you can use to take advantage of this. Like I said, OCO orders, which are offered on trade time in most platforms. Open, one cancels the other. Okay. Or you can trade on either side using support and resistance and open a buy position and a sell position with short stop losses and short and big take profit points. So if the euro bounces up for a second, you take that profit because you're taking that high, and the minute it hits that high profit level, so even if it reverses and whipsaws down, you've already taken your profit out of the market because you already set your take profit point. So the minute it soars up, you close, you automatically have your position closed. So there are many ways you can take advantage, but learning how, number one, is learning how all of these events are interrelated and why they're important is the basis of understanding the fundamentals of Forex. Then to add on different types of trading strategies and using other things besides these events. Like I said, understanding how to use the order entry system, understanding a hedge or a straddle strategy, have very little to do with all that technical analysis. It has to do with understanding of how to play the game and play it and use those rules to your advantage. So these are the fundamentals that affect the Forex market. And I'd like to thank you for joining our webinar. I want to wish everybody a happy and healthy new year in the coming year. And we will see you later in the week. One more class this year, and then we're rolling over to 2018. Have a good night now and best wishes. And again, go to www.tradetime.com and try them out. See how interesting they are. Okay, it's a great little platform. Great, and have a good night now. Bye.